We said, guys, this has no option. It will be a success. We must make it work. We said, hang on, why don't we go direct to the consumer and offer them the ability to pay over time anywhere they like? Don't be afraid to find someone who's doing something similar to what you do.
Your first entrepreneurial experience?
We just built a very bad mobile gaming company.
How was the idea for Zilch born?
Everyone's got a good idea, and it doesn't matter unless you can execute that idea. This is not a shiny, beautiful card that makes no money. This is actually a FinTech with a business model. And we did about 250 phone calls to raise that $12 million. You need to show that you have a debt line to scale to raise the equity, but you need the equity to raise the debt line.
How do you get going the next day?
Don't worry to hear the answer no. Just go and do something.
Hey guys, my name is Alex and welcome to Founders Hack, a YouTube channel where I interview entrepreneurs who started exciting businesses to get a glimpse into what motivates them, how they think, and how they overcome obstacles. The first video is actually a recording of a fireside chat I hosted a couple of months ago with Belamant, the founder and CEO of a buy now, pay later startup called Zilch. Philip started the company just 3 years ago, but he already managed to grow it to more than 500,000 customers and $500 million valuation. Philip was super honest with us, sharing the story of how Zilch came about and his take on the BNPL market in general. Enjoy the interview, like the video, and subscribe to my channel.
Hi, Philip, and thank you for taking the time to chat to us tonight.
Hey, Alex. Yeah, great to be here. Thank you very much for having me.
First of all, I wanted to ask you a couple of questions, like background questions about Zilch and what the business is, just to get everyone up to speed. So first of all, how would you describe what Zilch does and how is it different from a traditional credit card?
Yeah, so the space we're talking about with Zilch is come to be known as buy now, pay later, effectively. And just for those of you who don't know what buy now, pay later is, really, it's point of sale finance. So ultimately, it allows a customer to check out online typically and split the cost of that item into 4 installments and pay 0 fees and interest. So traditional point of sale finance, like we've all come to know and seen decades ago, would actually charge the fee or the APR to the customer. Buy now, pay later, flip that model on its head, and it makes its money from the retailer. So the retailer pays a commission per sale, and ultimately that commission amortizes the cost to the customer. So you checking out online can split the price of something into 4 or 6 payments and not have to pay any additional fees or interest to split the cost of that over time. So why that's so interesting, especially for our customers, is that unlike traditional credit models, any of us that have ever had a credit card will know, credit models are actually built on rolling the customer into an amount of money that they ultimately cannot afford to repay on time. That is how credit cards work. They don't want you to repay in 45 days because this way they can charge you fees and interest. And so with the buy now, pay later model, it's exactly the opposite. In fact, because we only make revenue from the retailer once when you check out, it's in our interest that you pay on time and every time. And so ultimately, this is why this has become so popular. It is the most responsible way and most affordable way for people to defer payment when they're checking out, more so than you've ever seen before. Of course, payday loans don't even come close, but credit cards and traditional lending products like point of sale finance don't come close to this model either. So our business really allows customers to split the price of goods into 4, anywhere that MasterCard is accepted. That's online, offline, Amazon, eBay, Etsy, not on the high street, everywhere, for no additional fees or interest of any kind.
Sounds exciting. So in terms of the stage you're at right now, I understand you now have more than 500,000 customers. And as you just explained in terms of your business model, you generate the revenue from the retailer. So am I right assuming that you're already generating revenue? And like a follow-up question, have you hit profitability yet?
Yeah, so for me, businesses like these typically what your shareholders don't want to see anytime soon is that you're hitting profitability on the bottom line, because ultimately it means you're not growing fast enough. You could be using that profit to launch a new country, a new territory, a new region. So we are unit economic profitable. That's what's important to me, and that's why I love this business. This is not a shiny, beautiful card with a cool app that makes no money. This is actually a fintech with a business model. So ultimately, if you look at the core business model here, what's happening is our customer goes to a retailer, checks out. We make around 4% per sale. The customer repays in 6 weeks. And so that doesn't sound like a lot, but ultimately what you need to realize is that we turn the book so fast that we turn the book almost 12 times per annum. So we're making 48% annualized return on capital, and the customer is paying nothing. So it's a phenomenal model, and very profitable at a unit economic perspective, from a unit economic perspective. But ultimately, we are investing all of that profitability back into growth. So that's where we are at with the business at the moment.
Cool, but do you take the credit risk if the customer doesn't repay? So this 4% that you're charging, it also has to kind of account for the possible credit risk?
That's 100% right. So ultimately, the value proposition for the retailer is that they don't take this risk. Similar to what PayPal did, if you think about how PayPal began, that was the really the value proposition of PayPal, right? It was that the retailer didn't take the chargeback risk. In this case, it's similar, except the risk is on credit. So we take the risk with the customer paying back, and ultimately we've built in the average losses into that margin. So our business, ultimately we've got a lifestyle business. It's really important to our customer. Our customers love our brand and our product. But if you look under the hood, really our business model is as simple as we borrow money from institutions, we clear and settle retailers on behalf of customers, we make 4%, and on average, we have losses that are less than that and cost of capital that's less than that. And the margin in between is what we make 12 times per annum. And that's ultimately the business model.
Awesome. This is like super clear. Thank you, Philip, for explaining that. Now, in terms of the competitive landscape, I guess the best known buy now, pay later provider is Klarna, because it probably has been around for a while now. I wanted to ask you, how are you different from Klarna and from other providers out there?
Yeah, so, if actually there's 3 companies that we really admire at Zilch. We don't see competition as a bad thing at all. You can learn from a lot of other businesses really. And the one thing I always say to the team is don't be afraid to find someone who's doing something similar to what you do. Rather download that product, have a look at it, play with it, and understand and learn what they've done really well and what they do badly. So there's 3 companies really in the space. Klarna is one of those. Affirm out of the US is another. And then Afterpay out of Australia is a really great business. We love them. We think they're a great product too. But actually what's interesting is all of these businesses are the same. They all have exactly the same business model, which is interesting. And subsequently, all the copycats who have come along after them, which are the likes of, the others that you see in the market today, they're all outright copycats, which again, I'm not saying is a bad thing, but they're exactly the same. And when I say that, what I mean by that is all of their business models are B2B2C. In other words, they go to a retailer, they sign a commission deal with the retailer, and the retailer promotes their service to the customer at checkout. For those of us on this call who have used one of these services, when you get to the checkout, you could pay with Klarna as an example. And so it's a B2B2C approach. And when we were setting up Zilch, we looked at the incumbents, and we tried to understand, why are they all the same? Why has no one done anything different? And it's quite simple, really. If you take those 3 companies, they sort of on average 10 years old. Klarna's 15 years plus now, and the youngest is actually probably Afterpay at about 8 or so years. And so the average is around 10. And the reality is 10 years ago, there was no easy and certainly no cheap way to speak to 1 billion consumers in a day. In fact, it was impossible. And so ultimately what happened here is these guys came up with a really interesting finance model, and they needed some way to distribute this model. And so what they did is they went to communities of people, which of course happened to be brands, and they said, why don't you distribute this for us, right? And so this is where the B2B2C model was born. But when we set up Zilch, we kind of took a different view of this. And we sort of cast our minds back to Amazon. And if you remove all the narrative fallacy around Amazon and we talk about actually what happened, the bare bones of this, they set up a brand that sold books online. And obviously in the beginning, analysts looked at this business and said, oh, this is an amazing online book company. And they missed the point. And the point was that even if Amazon didn't know it at the time, the point was they were building this infrastructure on top of which ultimately they could deliver anything. And if we think about what Amazon could have done with that infrastructure, they could have taken that and gone to each bookstore one by one and said to that bookstore, we'll integrate with you. And if you want to sell a book online, we'll show your book to your customer and we'll ship it to them in a day for you. Mm-hmm. And in my view, they would never have become the business they are today because they would have suffered the competition, they would have had to undercut, and ultimately they would have become UPS or DHL. But Amazon didn't do that. Amazon went directly to the customer and said that you can buy any book in the world and we'll ship it to you in a day. And guess what? It's not your problem how we do that, and it's not your problem how profitable that is for us, right? But we're going to solve that problem for you as a consumer. And so they forged this relationship direct with the consumer. And so for Zilch, our strategy, which is fundamentally different to point of sale finance, buy now, pay later, it's cash at the commodity. It's a commodity, right? It's just cash at the checkout. Mm-hmm. I don't like that business model. I like the Amazon model more. So what we did at Zilch is we said, hang on, why don't we go direct to the consumer and offer them the ability to pay over time anywhere they like. They can pay over time online, Amazon, eBay, Etsy, not on the high street, tap and pay over time anywhere they like. And we'll offer that to them. And what's great about this is that it's not the customer's problem how we do that. And it's not the customer's problem how profitable we are in doing that. And so we forge this relationship direct with the consumer that doesn't rely on the retailer. And this allows us over time to obviously launch other products and services. So we've built a similar network like Amazon, except ours is a digital payment network that plugs consumers in on the one side and every retailer in the world in on the other side. And what's phenomenal about this approach is tomorrow morning, we can dream up a new way to pay in 6 months, pay with crypto, pay with loyalty, go retrospectively and split. We could come up with new ways to pay and ship it for a dime to millions of our customers in a second, and they could use it at any retailer they like. Now, that's very different to someone like Klarna, who, if they come up with a new product, is going to have to ask the retailer to promote that product if the retailer wants to.
Yeah.
And so they are beholden to the retailer. And why? Because traditional point of sale finance companies, they don't have end consumers. Their consumer is the retailer. And so that's why Zilch is so different. And for us, really, buy now, pay later is just the starting point. We aspire to build so much more than that. And we've just announced Zilch Tap and Pay product. It'll be the first of its kind in the UK and Europe. So customers will be able to tap in store and split over time. And next week, we'll be announcing something new on top of that too, which no one else in the space has. And ultimately, this is why we feel it can go so much faster than anyone else you see in the market. And if you compare us, at the same time with someone like Affirm, who's worth $25 billion today, took them 9 years to get there. Today, if you compare our businesses year for year, we're currently at about 5 times ahead of them in volume, mostly just because of our approach to the market.
This is why I basically love your business model. And I think it's super, super smart. From the consumer standpoint, they can only use Klarna and others if Klarna has a relationship with the retailer, because it's the retailer offering the service. You are coming in and you are saying, okay, forget about whether we have or don't have a relationship with the retailer. You can pay anywhere with any merchant and any retailer that accepts MasterCard, which is basically any retailer in the world. So
that's absolutely, that's correct. And that's why we find, I would love to tell you we're so much smarter and but it's really just, it's like most business. That's not the case. The case is here that things have changed. We can speak to so many more customers in a day than we could ever do before. In fact, we can probably speak to more customers through our social media than Waitrose can speak to customers out of their own distribution network in a day. So we don't need to rely on brands to distribute our products anymore. That's what's so nice about the world today. You can build something interesting for consumers and actually go direct to that consumer. And the last comment I would make on this is people typically look at when I look at the credit card space, it's a good parallel to consider. A lot of people actually think that in-store credit cards, these in-store branded cards, credit cards, actually came after direct-to-consumer credit cards. That's what people think, but it's a misconception. In fact, it was the other way around. In fact, how this actually worked, in-store credit cards came first. And then what happened was you had some really smart companies like Amex and Capital One who looked at this model and said, well, hang on, why should we restrict the consumer experience just to the in-store? Why don't we go direct to the consumer and give them the functionality anywhere they like? And what I find interesting is, we're sitting almost watching the same movie again, except in buy now, pay later, and we feel like we're the only people in the cinema.
I love this analogy. Well, I want to move on to your personal story right now. You were born in South Africa, and as I understand, your first entrepreneurial experience was there. Tell us a little bit more about it.
Yeah, sure, Alex. So, as you say, I'm South African, and really through university was looking at. I studied mobile development and AI. In that time, a couple friends of ours, in South Africa, we were still using, and a lot of the world was at that time, Samsung D600 phones and things like this, right? The iPhone hadn't launched yet. And so all of us were still trying to download apps from different app stores, and data was actually really expensive in South Africa at the time, but there was starting to be an arbitrage between text messaging and data. And so, you started having some companies emerge that were building apps that would let you text via data rather than actual text message. Yeah. And that started creating an opportunity for social gaming. And I'm not talking about gambling. I'm talking about social gaming, stuff like Farmville as we knew it moving forward in, social media. And that really intrigued me. So, I had the idea to build basically a peer-to-peer gaming platform that would allow people to use data on their phones and compete with one another and win prizes. When I left university, that's where I really started. And I started my business immediately focusing on this. And so, we built a number of mobile games, of course, very interesting to try and get those on different app stores at the time. Samsung had their own app store, and every other, Nokia was the main brand at the time. They had their own app store. And, trying to basically, we spend most our time trying to build one app and provision it for all of the different handsets and handset sizes. You didn't have a one size fits all on iOS or Android. It didn't work like that. And so really we built games and we introduced credits into the game that people could transfer to one another. And ultimately what happened over time is people didn't really like our games. So they ultimately, but what we found was interesting is they were transferring credit. And so they stopped playing the games altogether. And in fact, we decided we would throw the games out and keep the credit transfer portion of the business. And so we actually built a mobile payments company, ultimately, that allowed people to use airtime and transfer that airtime to one another through our product. And then we started to doing airtime lending and went on to do virtual card issuance. And we became the first cash to virtual card product with Uber, for instance, in the whole of Africa. We worked with the World Food Program to distribute social grants on virtual cards and these types of things. So ultimately, we went from a mobile gaming company where people were buying carrots for a virtual farm, to them saying, we're not very interested in that, but luckily they were interested in the transfer side of things.
This is awesome. I love this story. So you basically started building a mobile gaming company and built a FinTech company.
Oh yeah, no, it was the worst day when we had to go to our whole team of animators who were drawing pixel animations and tell them that ultimately they just have to start drawing cash. It didn't go down too well for all of our creative team, but ultimately we just built a very bad mobile gaming company, and out of it we a fintech business was born. And I think it was also a case really of, it was probably about 5 or 7 years too early. Social gaming just, data was still too expensive. It made no sense to sit on your phone and consume mobile data, especially not in countries like, or continents like Africa. But, so it was probably a bit 6, 7, 8 years too early. But, we pivoted away from that into payments, and that's ultimately how I proceeded.
So going from there, with this experience of your first company, how was the idea for Zilch born?
Zilch was an interesting one. Ultimately, in that first business, I was very lucky to have a mentor really to help me with that. And that really was my father. So, he's a fantastic technologist, and, really always supported me going into IT. I want to say supported. I'm not sure if it was supported or pushed, but I'm very happy that he did. And, I always had his support and guidance. He was running a successful card payments company in South Africa. And when I started this venture, I went to him and I said to him, maybe it would be good for his payments business to fund this venture. And he disagreed. He said, no, I think it would be good for you to get some other person to fund this venture. So ultimately, that's what we did. And then after building this company, and we rolled out ultimately into 27 African countries, India, we became one of the largest issuers of MasterCard in Africa, and then merged that business into his. And that company and group was listed on the NASDAQ worth about $2 billion.
And did he have to pay for it then?
At that point, it was public, so the shareholders had to pay for it at that stage. So what was great about that experience is ultimately we got to work together and focus very much ultimately on fintech and financial inclusion. We worked hand in hand with the World Bank and the IFC, and we created a product 12 years ago already for a number of African countries that would allow our customer to walk into a clothing, healthcare, or food store physically, and we would have a MasterCard plastic in their hand. They could dial up on their green screen phone. We would triangulate them because there's no GPS in the phone. And if they were in that store, we would drop the money on the MasterCard and lock the card to that retailer. So they could insert the card with their food goods or their healthcare goods. We would clear and settle the retailer on their behalf, and they would pay back over about 8 weeks for no interest of any kind. And ultimately, we closed almost 50% of payday lending companies in a year. With this product in South Africa. We had more than 8 million customers on this product. It was very successful. And this was already 12 years ago. So when you fast forward now to Zilch, I moved across to the UK about 6 years ago, and it really was just looking at the market. Of course, I came across Klarna and a few of these companies. And what I felt interesting is that even though the UK is such a developed economy compared to the likes of South Africa or the rest of Africa, what I found interesting is that the same problems still exist. And you do not have this pervasive democratization of free credit. It hasn't happened. And you still have people paying huge sums of money, to access small sums of money, and it makes no sense. And so really, I basically leveraged the experience we had built in the past out of Africa, where things are a lot more difficult, frankly. There's no central bureaus in a lot of these countries. Customers have no documentation in some cases duplicate documentation. So doing IDV, AML, PEP sanction checks and getting that right is actually much more challenging. And of course, trying to build a credit model in a country where this is going on is much more challenging than in the likes of the UK, where fortunately we have centralized bureaus and we've got a lot more accurate data. And so that's really, I used a lot of that experience and brought it into this venture. And so, arriving in the UK, very difficult even for me to get a bank account, setting up a business. It took 3 months to get a business bank account, and then not to mention credit cards. And I basically just looked at this and I thought, it's amazing that we almost have the same problem in the UK that I had experienced many years back already in South Africa and Africa. And that's where I kind of looked at this and I thought this could be a fantastic opportunity, basically to modernize what we effectively have done 12, 13 years ago already, and bring it, virtual, bring it online, through a venture like Zilch. So that's really where the idea came from.
So, and then did you have the same kind of idea at the beginning? So the buy now, pay later, but where you own the relationship with the customer and they can pay everywhere. So I guess, was it the initial idea, or did you have to pivot at some point?
No, that was always the idea. So for me, and I'll say again, I've got nothing against these companies because there's some brilliant businesses. I mean, to be honest, they're inspiring. I just don't like the model.
But I guess then the question is, like, for your business model, what the crucial point is, and it is your unique selling point, is the partnership with MasterCard. So then how did you, if that was the initial idea, I guess you had to go to MasterCard and get the partnership before you actually launched. How did you manage that?
Well, fortunately, like I mentioned, we were one of the largest issuers of MasterCard in my previous business. Mm-hmm. So we knew the team very well. The MasterCard's team is basically for Africa, is overseen by Europe. And so really we just gave them a call and said, hey guys, here is a new venture. We've done this before, we've issued tens of millions of cards with you before. And, and ultimately we've got a new venture and a new idea, and we'd like you to participate. And, MasterCard, obviously, we're very interested to do so. So, I think certainly track record helps in delivery. Yeah. When you're doing these things, the first time around, perhaps not as easy, but in this venture, it was easier for us to pique the interest of the likes of MasterCard, because of course they were looking and saying, we've done something with you before and it worked very well. So we're really excited and interested about this new venture.
That is great. Yeah. How did you go about building an MVP, or did you actually have to build an MVP, or were you just building the finished product straight away because you knew it's going to work?
Yeah, I would say, what's interesting is this is where, the one thing I always say to our team, and the advice from my side on this is, don't be afraid of the competition, and also don't let confirmation bias creep in when you're looking at a new idea, because a lot of people I found come up with an idea and they want Google to tell them that no one else has done this. So they tend to take that bias. What I prefer to do is I like to go and try and find the product that I want to use and go and use as many of those products as I can. And that's really how I came to learn about, in detail, these other players like the Klarnas of the world. And just in using the products, it became clear to me that the checkout experience for me as a customer is fragmented. I go to one site, there's a particular buy now, pay later. I go to another site, it's a different one. I have to get a deal from another site. I have to get a cashback from a separate site. And all I want to do is consolidate that value and check out. So for me as a customer, I just looked at this and I thought there must be an opportunity to do this better. So when I put Zilch together as an MVP, ultimately this was, a big team effort, and we have a phenomenal group of people in our business, and so as we formed the team, it was 4 of us initially. And really I said to the guys, we have to have a relationship with the customer. It must be the case. And this is the model we want to deploy. But ultimately, it's like anything, you always continue to iterate. But the good news is the core value proposition. You had bigger companies that had spent millions doing market research and were educating the customers about this, and which was phenomenal for us. And actually, I hope they keep doing it, and it's great. Because we can come along after them, and we can simply offer a 10x experience. And so Yeah, we were fortunate in this case. We didn't have to iterate the proposition much. And so the MVP took us about 3 months to get up and running, which is, pretty good record time when it comes to integrating, of course, with a card payment network. So issuing and acquiring on both sides, but about 3 months to get up and running, and then probably at least another good 6 months of beta testing live thereafter. But that's how we went about it. And fortunately, we had a good view of how this product should work from the start.
Sounds amazing. Really good. So then going from MVP onto product market fit, what was your experience? Did it happen right away?
I wouldn't say right away. We were going to launch a subscription product to start. And ultimately, we felt that we needed to go to the regulator and talk to them about this product, even though in the UK, up until very recently, the buy now, pay later model has been exempt by the FCA. We always tend to take a conservative view on this, particularly when you directly are forming a relationship with the customer. We want to be, providing them the most responsible way to use this product. And so, 2 years ago already, we went to the regulator and we said, this is what we're planning. This is how we want it to work. And they basically told us that will not work. And we will need to be regulated to operate that particular model. And so we said, okay, well, that's fine. Well, then let's work together. And, fortunately in the UK, they have, a very interesting program that you can enter with the FCA, that allows you really to throw around your ideas, and they give you a lot of support. And we worked hand in hand with them to get our license. We're the only regulated provider, BNPL provider in the UK today. That includes, of course, all of the brands we've talked about, none of which have licensing today. And so we had to actually start to pivot and change how the product would work, ultimately to bring it to market sooner, whilst we were working with the FCA and figure out a product market fit. And so what we decided is, let's not make how we build our revenue the problem of the customers. That's our problem. And so ultimately we launched a free product whilst working hand in hand with the FCA. And then we had to try and build a plan on how we were going to make revenue out of that product. So it's like anything, you feel like you have an idea of how something should work, and along the way you have to change that. And I'm sure we're going to have many examples of this moving forward too.
So basically, if I'm right, your initial idea was to charge people for a subscription to use the service. And then it was not possible, so you had to go and offer a free model. And then figure out a way.
A combination of, it would have been possible, but what we actually decided was that we didn't feel the value proposition was right. We felt like we were making our revenue the customer's problem. And for us, again, coming back to the Amazon analogy, we just took the view of, why should this be the customer's problem? And so we pivoted, and frankly, we've built a fantastic model now, very unique in the space, that allows us, to earn revenue per transaction from the retailer without having to put the burden on the consumer.
But at the same time, you don't have to go to each and every retailer, because MasterCard kind of handles that part. So am I right? So you don't have to have like 1,000 of salespeople trying to negotiate with each and every retailer.
It's exactly right, to be honest. Okay. That's spot on, Alex. So we set ourselves two major goals for the business when we started the company. The first goal was, how can we integrate with every retailer and never speak to them? And the second goal was, how can we bring that retailer value and earn commission per sale from them and never speak to them? And in doing that and in achieving those two things, we've built a model that's really, truly very unique. And as you mentioned, the first one we solved, of course, with a card scheme. So we call this business an over-the-top model. We've built the buy now, pay later product over the top, on top of the MasterCard rails. And that allows us to integrate instantaneously everywhere. And then, on the revenue side, there's a little bit of secret sauce in there that we will, some of our investors are very interested in. But ultimately, Those are the two things, the two problems we solved in this business that have allowed us to build something so much more scalable than we see in point of sale.
That is super smart. You raised around $4 to $5 million of capital. I know you just shared with me right before the call that there is another round that will be announced next week. So guys who are listening, keep an eye on the announcements, and that will be a big one. So I don't know if you can say anything on the most recent big one. And another question that I always love to ask is, tell us the most, let's say, memorable story, capital raising story you had so far.
Yeah, sure. So, the business has been growing tremendously fast. So we only really started with our first funding round. Fortunately, the co-founders of the business were in a position where each of us had built businesses in the past. So we funded the business initially ourselves. And then, pretty much January of last year, we went out and said, let's start to look at raising some external funding. We've built the business to a unit economic position that we know the model works with our own money. Let's go and look at bringing in some third-party capital. And as we all know, unfortunately, COVID came along quite swiftly after that. So, we just had experiences that unfortunately are, ones that we don't want to remember. We had a couple VCs that had sent us high-level term sheets and reneged on those term sheets ultimately when COVID came along. And a few private investors, this happened too, which I suppose, the world turned upside down. No one knew what was going on. And basically people said, well, we can't make a decision. Yeah. So at that point, we decided to invest further in the business. We thought this is where we double down. This is our opportunity to really scale this company and build the team, invest in the team, while everyone else is furloughing and trying to hang on to what they've got. We thought this is an opportunity to accelerate. And so ultimately, that's what we did. We invested further, more so in our own vision ourselves. And that took us through right into the middle of COVID, at which point we said, let's go back to the market and see how the market receives us this time. And we did about 250 phone calls of pitching, initially to raise that $12 million in the middle of COVID. And so it was good fun, as you can imagine. You say the same story again and again and again. Eventually, I thought I should just tape it and I could play it. But for anyone here that's done some capital raising, for new ventures, I'm sure they can relate. But ultimately, we basically grind it out. I think this is the thing I found interesting, about every venture is it's a lot of it's really attrition. And we're fortunate to have a phenomenal a team in the company and also a phenomenal group of co-founders. So really we said, guys, this has no option. It will be a success. We must make it work. And so we really went out, we did those calls, and that was the first round of funding that came in. Subsequently, of course, we did the next round for $30+ million at the end of last year, and that took us a week to close. We didn't even have time to do a formal pitch deck. By the time we had the deck, the round was closed. So it's just interesting to see how things work. But that first experience for us really did teach us, I think, a few things. Don't always count on VCs. It's not necessarily always the best route to go, particularly if you have deep knowledge of the sector yourself.
Wow, that is a great lesson and also very inspiring. The last question before we go into the Q&A, are you hiring? Will you be hiring? Where can people find job posts?
We'll be hiring about 100 new positions into the company. So we're really gearing up to look at international now markets and launching in other countries. And this round is going to help us do this. So we're going to be announcing this next week, and we're going to be posting all of these positions online from next week as soon as we announce the round. And so you can go to payzilch.com if anyone here is interested in these roles. We're going to be hiring across the board, and that's different levels of obviously experience as well. So a lot of roles in data science, engineering, product, etc.
Amazing. Thank you.
To be honest, they did help us a lot. So the sandbox process, as they call it, I will say is one of the most forward-thinking processes we've seen. It's not many regulators that say, we're going to give you an environment that you can try and innovate in. Now, look, ultimately, how much regulation ends up changing out of that process, I'm not too sure. It would be interesting to know, but we certainly did get quite a lot of support from the FCA. They played quite a fundamental role in looking at how we are doing basically affordability analysis on the customer, which is really what the FCA's major focus is on. It's not so much credit worthiness, it's affordability. And so, so they actually did participate a huge amount. And over that 2-year period, we did a lot of testing. We shared the data back with them. And in fact, there are cohorts of data we will still make available to them so that they can get a better view as to how the model rolls out. I would say the best way I can say is it's a pain in the ass, to be honest. So you have a chicken and an egg scenario with any lending business. You need to show that you have a debt line to scale to raise the equity, but you need the equity to raise the debt line. And so ultimately what we chose to do, what we found is that there are a number of lenders that take a venture approach to this in the UK. And actually there are quite a number of them, I will say. But of course the rates are exorbitant. And along with the exorbitant rate also comes warrants that they would like in the business. And you can understand this, right? I suppose in the beginning, you don't have a credit policy that you've rolled out over many years, and you don't have a track record of lending and actually getting the money back. So we took the decision to go and invest in the debt book off of our balance sheet ourselves. And ultimately that means, we became really the subordinated junior debt piece in the book, on top of which it's easier to bring in a senior. So we would be the first losses of the book. And what that did is give third-party lenders confidence that our credit policy is working. And of course, there is that protection against first-time losses if it's not. With that said, we actually, ultimately, we tried to hold off doing a third-party deal for as long as we could, because ultimately it's in our interest, in fact, to wait longer. It's in a third-party debt provider's interest to do a deal sooner, because as we wait longer, you start moving out of niche lending, let's say mezzanine rates, to traditional rates, and then even to fixed income rates, which could be as low as 3-4% per annum. So it's in our interest to wait. But what we have done is, up until now, we funded off the balance sheet. We've brought in a small line. And we will be replacing that with a much larger institutional tier 1 line very soon, and we'll be announcing that in the next few months. Ultimately, we're making use of a number of things. So there's a lot of ways to make. I can't specifically talk about the entire revenue model of the company. But what I will say is that there are numerous ways to bring leads to retailers and make revenues or commissions per sale, that don't require you to have, go and basically pitch one retailer at a time. And so what we're doing is making use of an advanced machine learning system on the back end to optimize how it is that our customers are traveling to retailers every time it is they want to check out. And this allows us to generate revenue from retailers without having to sit and speak to each of them. So that's as much as I can share. And I hope that at least, I'm sure for a lot of you, you're probably sitting thinking, I'm sure I know how this works. So, really, it's almost a little bit of the same people. So the first execs in the business really joined the business from day one. In terms of on the founding side, so they almost really are, shareholders in the business and really pseudo founders to the company. And I'll talk a bit very quickly about them. But before I do that, I come to them on the founder side. So the initial investors in the business as founders. When I moved over to the UK, I was fortunate enough to meet with someone who became then a friend, an entrepreneur in the UK, and was self-made and had done very well in a number of businesses before this. And so we really just got to, sitting down together every time he was in London and catching up and talking about what I was busy with, what I was looking at and of course the projects he was busy with. And, I was just kicking this idea around with him and saying, I'm looking at this is interesting. We have comparables that we know we can launch something that's faster and more scalable to, and this model works anyway really well. And, he said, that sounds phenomenal. Let's do it. And ultimately, it was really that formed the initial a founding team with two others. The one, as I mentioned earlier, my father as well, who I always work with. And then on top of that, another friend in customer acquisition, a customer acquisition specialist who's built and sold numerous companies before just based on customer acquisition. And for this business, we obviously said this is a direct-to-consumer business. We need that skill set. And so that really became the initial investors and founders in the business. But ultimately, like I say, subsequent to that, it's really all about the execution. Everyone's got a good idea, and it doesn't matter unless you can execute that idea. And so that's really the executive team in this company. And those are people I've known before. So similar to what you might, you tend to reach out to people you've worked with before and you thought were amazing. This was the case for me again here. So reached out to our COO, gentleman by the name of Rakesh, our CFO, his name is Hugh, and CIO Sean were the initial executives to join the business. And all of these people I've either known for many years, worked with before, or seen the work they've done before. And so really just reached out to them and said, look, here's the idea. We're going to do it anyway. Do you want to, but we think we could have a far better chance of success and enjoy ourselves a lot more if you guys would join this venture and help me. And ultimately, thankfully they did. So and these guys are, from backgrounds sort of either parallel or adjacent to the space we're talking about today. So a lot of experience in building elastic, hyperscalable infrastructure, a lot of experience in operation and people management. We've just built a team of 100 staff in the middle of a pandemic. It's not so easy. And then ultimately experience in debt finance, capital markets as well. So yeah, that's what we did. It's reaching out to people that I've worked with or seen work well before and really selling them the vision of the idea. And luckily, they chose to join and we haven't looked back since. The aspiration for us is to become the best way to pay over time for our customer. Mm-hmm. So we want there to be as little friction in our experience for our customer. We want them to be able to pay over time wherever they like. But the aspiration is that we remove the two words over time. And so we would like to become the best way to pay. And so ultimately, that's where we would like to be, is that, our customer knows with our product, they don't have to bank with us. You don't have to move your account to us because no one needs another bank account. We've got a lot of those. But our customer could use our product to pay now, pay later, pay even later, retrospectively change their minds and fund those transactions with, for instance, fiat, loyalty, crypto, etc. And so really what we're trying to build, our vision is to build something that over time allows you to use any source of wealth you have, whether that's fractional ownership in a piece of art, whether that's a non-fungible token for a piece of artwork, whether that's crypto, whether that's something else. You should be able to really use any of your wealth to fund a transaction, and you should be able to pay for that transaction how you like, today, tomorrow, in a few weeks, in a few months, etc. And so the vision for the business is really to build on the relationship we have with our customer and bring them the most convenience in how they're paying, and so ultimately become the best way to pay. I'm not sure if it's two questions, but I'll answer it in two ways. So, so any mantra or trick, I suppose, as a founder to get going, my answer there would just be to just do something, just go and do something. I feel like that's the only piece of advice we give to people joining our business today, is to just go and do something. People overthink things. We've all got great ideas and you don't act on them and nothing ever happens. So the first thing I would say is just do something. And it's a little bit the same when it comes to raising that first seed round. I think the biggest advice I would give, and it's hard, it is very hard, but don't be don't worry to hear the answer no. That is probably the single best advice I can give, is don't be afraid to hear the word no. And even in the beginning for me, it hurt because it's your idea, it's your thing. You speak to the first person or second person or third person, they say no. You just haven't found the right person yet. So my advice would be just don't be afraid to hear no. And ultimately, really just use the network you have to reach out and don't be shy to ask.
When you had these 250 calls, judging by the number of 250, you must have heard like at least 200 no's. How do you get going the next day?
Yeah, I think this is just the thing. You have to get comfortable with hearing no, and more importantly, understand why, I think is really important. So, what I found was a lot of people don't actually understand what you're trying to do. And that doesn't mean it's just so complex that they can't understand it. It's just maybe they don't have the context. And of course, you've got a short amount of time to really try and get this person to buy in. And, and my view is that as long as you appreciate that everyone's got a different viewpoint. I mean, people have passed on mega companies, right? People have passed on Uber, people have passed on Facebook, people have passed on many, many, many opportunities that have turned out to be phenomenal. And that's really, I suppose, what you're going to remind yourself. But most importantly, I will say, if you have a group of people around you, that believe and are supportive, that does help. For instance, a co-founder of mine, would also take this approach. So if I've heard no 3 times that day and, I speak to him the next morning, he'd be like, don't worry about it. We've got another 5 calls today. We'll get it. Right. So it is great to surround yourself with some support. I would say you're trying to find a co-founder, which is really hard, or a phenomenal team that you have around you that can support you is really useful. But ultimately, it really comes down to being comfortable hearing the word no, and it is uncomfortable to start with.
Well, great. That's an amazing advice.
Initially, there was 2 schools of thought. So there's open banking, and then there's obviously a credit mindset on open banking. Now in Zilch, we've built our own proprietary credit scoring. So we make use of things like a soft credit check, etc. But what we found is, to be honest, is that a lot of our customers are thin file, or no file credit customers. They're not bad credit. They just don't have credit files. So it doesn't really help to go and pull an Equifax credit score for this customer because they don't know anything about them. And so we've had to build our own proprietary way of taking a view on the customer. Open banking is, of course, a phenomenal way for us to do that. And so really, where we had the option initially of going for a provider that would just allow us access to open banking versus a provider that would allow us some insight on that open banking from a credit perspective, we chose to go for the latter. And then in that decision, we did have a look at 2 or 3 suppliers. And ultimately, what we found was Credit Kudos to be the most forthcoming at the time and excited about this. And really, to be honest, it's a little bit like how we hire in our business. And that is that, we really prioritize, people's want to do a great job and their enthusiasm about the opportunity actually above sometimes skill. And so in this case, it really came down to the fact that Credit Kudos really were very excited about the opportunity. We're hungry to work with us, and we appreciated that. What we find is that lots of big companies really are enthusiastic to work with us now, but they weren't so enthusiastic a year ago. And so we really appreciated that. And it was a combination of those 2 things which led us to working with Credit Kudos.
Perfect. Thank you, Philip, for answering the question. So, guys, I think that was our last question for tonight. Thank you, Philip, so much for sharing your story today. It was super insightful and inspiring at the same time. Thanks a lot.
Not a problem at all. Thanks for having me, Alex, and great to have everyone join the call. Thanks for the time. I hope it was useful anyway. And as I mentioned, we'll be letting everybody know the roles that we're looking to fill next week. If anyone has any interest in our business and our story, maybe you could be part of it. So it'd be great to hear from you. But otherwise, again, thanks for the time, and I hope it was useful.
Hey again, guys. I hope you enjoyed the chat with Philip. Please support my channel by clicking the like button, and don't forget to subscribe so that you don't miss our next episode. It's already in the making. Take care and see you soon.